let's talk about the issues that you guys are facing.
Well, just let me add that, because Craig made this point, I'm sorry. But it's about giving lenders the reason to let credit go. You know, putting money in the system isn't going to do that in and of itself, right? And the accounting standards are part of it, but giving CIOs a reason to make credit decisions, I think is critical.
Good points there. For those of you that are keeping track in the audience, we've moved now from the first phase, general market conditions, to the second phase, changes to the buyouts business. And let's start with the most obvious question for everyone in this room. Is there any sector that's going to be immune?
I don't think so. I mean, I'm in healthcare. A lot of people traditionally think that that's a relatively, safe sector. But a lot of the way you made returns in healthcare was frankly doing acquisitions, because healthcare is delivered so locally that you have to buy businesses and to build a big business. Well, in order to do acquisitions, you need financing. So even healthcare is not protected. Certainly, I'd rather be a healthcare investor than a consumer products investor right now, but I think everything's going to be affected.
I agree with that. I'd say the one thing that's probably a little different, and we each target different sized companies, within any sector, no matter how bad it is, there are proportionally more winners, and our job is to try to find those. So I'd say even though you may.
So the next question is, where are you looking for them? Where's the pony here? Is there a pony? Can we find it? And if there is, are you going to tell it in front of everyone else?
I think it's pretty easy. I mean, Craig already says, Warren Buffett's got it right. Buy everything. It's a buying market.
Yeah, really hard to miss Warren Buffett's advice. So what degree of leverage did you traditionally put on companies, and what's that like now? I said that the industry average earlier was 9.5 times EBITDA, and what would you say you've done in the past versus what you plan on doing in the future?
I think you're correct. I'm probably at the extreme to the low end. The size deals we took, leverage historically has been very proportional to the size company, and the premise of just small companies are deemed more fragile, and there's certainly some validity to that. So I'd say the size deals that we do, which, as Alex said, generally it's revenue 10 to 50 million, of revenue, and EBITDA might be 3 to 10 for us. At that range, I'd say that the peak we would get 4 to 5.5 times, which is certainly a lot less than that. I mean, right now, I'd say until 60 or 70 days ago, we also had the advantage of there's still a lot of pockets of money out there. It's hard to get a huge deal syndicated, but there's still community banks in New Jersey that if a company based in New Jersey, you can go get 2 to 3 times leverage on some of these smaller deals we chase. But I'd say in the last 45 days, it's really backed up to probably 1.5 times to the high end of leverage that we can get on anything right now.
Great.
Yeah, I mean, one of the fortunate things about the group here is that our firms have never made returns just from the use of leverage. I mean, there's really 3 ways to make return: buy low, sell high. Most of us don't think we're smart enough to do that. The second is, earnings growth, helping your companies grow, and the third is the use of financial engineering leverage. While leverage is part of a lot of the deals we do, it's actually, if you actually segment out where the returns come from, at least for us, it's mostly earnings growth is where it comes. But the biggest issue is, can you get anything financed? I think that Phil said it right. And sometimes it's not a matter of this much leverage, just there's no place to get it. GE accounted for 25% of middle market lending, and they literally just shut down in the fourth quarter. A lot of deals we were working on with them, they just said we're not doing any lending. So it wasn't a matter of multiples. But if I had to say, before, some of our deals are bigger leverage buyouts, we would sometimes put 6 times leverage on that. We are usually not the firm to top tick leverage because we're a growth investor. We don't need to do that. And now you're seeing much more like 3 times, 3 or 4 times leverage.
Scott, you want to finish this out? What leverage multiples did you used to see, and what are you seeing now?
Well, we do a lot of distressed investing where we're buying cash flow native businesses, and we do use leverage, but it's mostly asset-based leverage. So, our stats for the last 5 years were 9.5 times EBITDA, it turns out. Not because we're paying 15, we actually paid like 2, but we were leveraging native cash flow businesses. The last 2 deals we did, we funded 100% with equity. But one of the things, to the point of how you create returns, while leverage helps you get a better return, lower purchase
So Steve Kaplan, a professor at the University of Chicago's GSB, says that the amount of leverage you guys will see has gone down and will stay down. Is he right? Is there anything that could bring leverage multiples back up?
I think it's a whole nother generation. We got to go through a whole generational shift in investment banks before leverage will, and maybe it'll never get back to the levels it was at.
So a decade.
More than that, I would say.
Well, you could argue we don't want it to ever go back to where it was. I mean, there was a time where it was such a bubble, and we saw that where we were getting deals done with no covenants, or one or two covenants, and massive leverage levels, and you just knew that that was, not a sustainable kind of feature. So, as long as the asset values come down, and you can buy at a reasonable price, we should all be okay in our industry.
Bill,
Yeah,
thoughts?
I mean, quickly, I don't think we'll ever go back to being able to buy Univision for 16 or 17 times cash flow with 12 and a half times debt. I just think that's probably gone forever. And, can you buy Univision for 10 or 11 times with 5 or 6 times debt? Absolutely, it's probably not anytime soon. But some of these businesses will be sustainable.
Talking about the numbers is one thing, and that's useful, but often the terms of the deal are just as important, and you heard Craig just mention that. During the past 3 or 4 years, we've seen the development of covenant-light loans with their easy repayment terms, payment-in-kind bonds, which allow debt to be paid with stock, dividend recaps, PIK toggles, and about half a dozen other things I had to look up to understand what was going on. Basically, a lot of complicated ways of making deals easier to do and better for the investors. What's happened to those?
Well, I think you got a flavor of it. Just the first problem is a lot of the lenders don't want to lend, and if you look, they could actually be buying the debt of corporate America right now, which is trading in the 70s after 9/11 and traded around the 90s, and everyone thought that was horrible, and now it's in the 70s, which implies that corporate debt is trading something at a yield of like LIBOR plus 600, some real huge number. And I can tell you that I would personally like to be buying the debt of a lot of the companies I look at. It turns out it's very hard to do that as an individual. But right now we are in a situation that the lenders don't want to lend. And because of that, if you do get these loans, you're going to have very restrictive type covenants that won't give much flexibility at all.
Yeah, I say that the terms you all mentioned, the equivalent of the mortgage broker doing a 2-year option arm, and there's no risk to him. He pawned that piece of paper off to somebody else, and really all the things you talked about, those were all in large syndicated loans where the whole premise was get this thing off our balance sheet as quick as possible, and who really cares whether or not there's a PIK toggle or any other feature that you talked about. I think you go back to a thing where the lending universe is going to have this stuck in the balance sheets. It's going to be just like the local community bank that lends you in your house, that they're probably not real inclined to have a 2-year adjust rate arm on their balance sheet. So I think you'll get rid of a lot of these terms as some of these larger loans really end up getting stuck on the lending institutions that are originating them.
How are your IRR targets changed?
They have not. Our firm's, been fortunate enough since 1984 to generate north of 30% IRR. We do that mostly by targeting high-growth companies, and we have a huge staff of people that are calling probably some of the CEOs in this room, and we're in touch with 25,000 companies a year, and we form relationships, and we eventually do 15 deals a year with this gigantic funnel. So we still believe we should be able to generate great returns. For the bigger deals, we might target a mid-20 type return, but we don't believe, in fact, we think it's a great buying opportunity. As I was saying.
Our target's going up. We're in a distressed market, so we'll do better, so higher standard.
But I think in our industry right now, there's no shortage of buyers. I mean, every one of us would aggressively go buy anything right now. It's just on our terms, and the big disconnect is you got the sellers who sit here and say, geez, I really wish I'd sold last spring. We've been not going to see that for a long time. So, hey, if I thought it was worth 10 times, maybe I'll take 8 times today. We're sitting here saying, geez, I can't get any debt. I'll pay you 5 times. There's a very big, it's just not a rational market where there's willing buyers and willing sellers, but there's no shortage of buyers on, I think, the terms that we like to get, which justify the returns that Scott Craig talked about.
The types of turns that you're